If we value gold at 20,000 at some point to market, or whether we try to force that, I think we'll let it run to 20,000 at least in our lifetimes, in my lifetime easily. And that will take a hell of a lot of pressure off the yield curve, but it will also slowly devalue the dollar even further, which is really what Trump and Bessent want to win the trade war. They need a cheaper, weaker dollar. They just don't want to say it out loud. And of course, that will be great for U.S. trade. It'll be great for the trade wars. It'll be great for demonetizing or de-deficiting our debt, but it will be very, very hard on Main Street middle-class Americans who still think their dollar is what measures their wealth. That dollar is melting, and it will continue to melt as we revalue gold and as we monetize our treasury market with more printed dollars from the short end of the yield curve or from whatever tricks we have at the Fed. It's just debasement. It's just debasement.
Global monetary systems are hitting an unsustainable breaking point under massive national debt burdens and currency debasement. The decades-long reliance on unbacked paper assets is unraveling as sovereign entities refuse promises and accumulate tangible reserves. Matthew Piepenburg, commercial director at Matterhorn Asset Management, financial attorney, and macroeconomics author, underscores that Western derivative markets have lost their grip on physical bullion pricing. Decades of paper contract leverage are rapidly unwinding as real inventory exits Western vaults for the East. Under these structural shifts, gold is predicted to climb to $20,000 per ounce within our lifetime. While this historic revaluation will relieve massive yield curve pressures and monetize sovereign debt, it will accelerate dollar debasement and diminish domestic purchasing power. Now, we present the clips from Matthew Piepenburg's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Most of the central banks that are getting the memo are Eastern central banks. I mean, the biggest export out of the U.S. earlier this year was gold because of the outflows out of the COMEX and out of the LBMA market in London and in the COMEX in New York, the vaults there. You have to ask, why are all these counterparties who are very happy churning and burning and playing this game of I'll pretend to buy, you pretend to sell, we'll just extend the contract. We know we got 10 claims for the same bar of gold, so let's just keep extending and pretending. What happened in 24, 25, and certainly into 26 is counterparties no longer wanted a paper claim backed gold interest or silver interest. They wanted the real metal. And that's why these exchanges, the Western exchanges that set the price, saw this exodus of gold and silver out of their warehouses, primarily to sovereign wealth funds and central banks elsewhere. And that raises a number of implications. That the COMEX is no longer the price fixer that it used to be for 50 years. It's losing its ability to price fix because it doesn't have the metals to lever to short gold and silver. Its only tricks left were to raise margins, which they did in early 2026 and squeeze, got the banks out of a silver squeeze, and basically it was a bank bailout, but they pushed the price of silver down unnaturally overnight. But what that means, the implications are that was also because central banks and big players and the whales want the physical metal now. They don't want paper claims. They don't want COMEX futures contracts. They don't want the old system. They want the real metal because they don't trust the old system and they don't trust the old currencies, including the US dollar and US Treasury. Again, objectively, the evidence is overwhelming. What's also happening at the same time, as the COMEX is running out of physical metals, physical gold and silver, is that you have in the East, not just the BRICS and their BRICS-backed trade settlement, resolve. They're not a BRICS-backed, gold-backed BRICS currency, but they're using gold to net settle trades. We're seeing gold being used to even net settle oil trades outside of the petrodollar. We've been seeing this for years, since 2022. But in addition to all that, where gold is a more primary role, we're also seeing that Shanghai and Hong Kong have been waiting for this. They're going to create a clearing and settlement. They started this summer, and it's only going to get more and more momentum. They're creating a clearing and settlement system that is based on physical gold, not paper claims to gold. When we went and played that game with the COMEX in the 70s, I think it was literally like a Tom Clancy novel. You had, I think it was the U.S. Embassy in London, the CIA making phone calls. We're going to create this exchange. We're going to put a boot to the neck of gold and silver. That's going to make the dollar look respectable. The Chinese got that memo back in the 70s. They saw what we were doing. They saw what we were doing with QE in 2009, 10, 11. By 2014, they started dumping our treasuries. And they knew that there was only so long that we could play this game, that the dollar would eventually get itself over its skis in debt, that it wouldn't be our currency, your problem, it would be our problem as a whole. And they knew that eventually, after going off the gold standard in 71, gold would rear its honest head again at some point as more trusted. That's just long-term thinking. The Chinese play a lot farther ahead than the West. And so what they're doing now is they're creating a clearing and settlement system between Hong Kong and Shanghai, where gold will be priced on physical properties, not paper claims. Again, that doesn't mean gold goes to 8,000 July 24th. It just means that, as usual, and I'm not a shill for China, you have to respect your adversary. You have to. It's the art of war. Respect your adversary. They've watched us shoot ourselves in the foot year after year, trillion after trillion, U.S. Treasury after U.S. Treasury, and they're seeing the world not going to a gold-backed yuan or ruble or BRICS currency. They're seeing the world going to gold-backed collateral. And they're stacking their gold and they're pricing gold based on physical, not paper claims, which is an insult to supply and demand. And so that's happening as we speak, and that just proves the new direction is still going to be fairer price discovery in gold, set more in the East, as, by the way, the head of the Shanghai Exchange told the West in 2014 when no one took China seriously. He said to a bunch of Western bankers, soon China will be setting the gold price. That was unthinkable 14 years ago or 12 years ago, but it's happening. And you can't have a 200-day moving average in gold and silver in the East that's significantly fairer priced than the paper market in the West. And again, as we're arguing about tariffs in Canada, or what drone swarms are destroying American initiatives in Iran, or whether this is a good or bad war, whether it's an Israeli-led war, whether it's an oil-led war, all this debate, our currency system is shifting right underneath our feet, and it's going, and gold and the currency and the net settlement is moving from west to east. And again, the dollar is not going to disappear and America's not going to be in ruin. It's just going to be repriced. There's going to be more austerity, more pain, more inflation, and more deflation, by the way, based on so many factors. But the bottom line is the dollar many of us were born with and thought was sacred and immortal, and the S&P that we thought could never go down, that a dip couldn't be recovered. All these things are changing. It doesn't mean the end, it just means radical change. You've got to be prepared for change. I think it's hard to see change when you're living in it, but we are seeing a sea change in the global monetary system, which was led by the US dollar post-1944 Bretton Woods, which was insulted by Nixon in 1971, which bought us about 5 decades of time until we got ourselves in debt like drunken sailors. And even that unbacked, nothing-backed dollar is not what it was in 1971. It's lost 99% versus a milligram of gold. So now the world wants a better collateral, a better asset than an IOU from Uncle Sam. And this is why central banks are panicking, and this is why we're seeing the stacking. And this is why I think Besant and Warsh have no choice but to continue to debase until their last resort is their golden piggy bank of 8,131 tons of supposedly audited or unaudited gold in Fort Knox in New York, valued at 1973, $42.22 or 21-cent valuation per ounce. At some point, they're going to let that gold price run to market, or they'll reprice it themselves. That's a debate. But that's our last piggy bank option. Ironically, gold, which was the enemy of the dollar, as Volcker said decades ago, is now our last hope. And that full circle move from getting off the dollar in 71 to looking to getting off the gold-backed dollar in 71 to now looking to gold and our reserves to monetize our balance sheet, to save us from our debt crisis is the height of irony. It's the full circle. But the irony is, the bigger irony is, 250 years ago, our founding fathers warned us in the very first article of our Constitution, don't get off the sound money. Our dollar is based on silver and metal and gold. It talked about this, it warned us of this, and here we are, right where they promised us we'd be, in a mess. And so it really is fascinating. But yeah, now gold, which was the enemy, is tragically the last place we can go to get QE without QE. It's gold QE. Revalue the gold, pay down some of the young end of the yield curve, reestablish our M0 money supply, etc. It gets wonky, but if we value gold at 20,000 at some point to market, or whether we try to force that, I think we'll let it run to 20,000 at least in our lifetimes, in my lifetime easily, and that will take a hell of a lot of pressure off the yield curve. but it will also slowly devalue the dollar even further, which is really what Trump and Besant want to win the trade war. They need a cheaper, weaker dollar. They just don't want to say it out loud. And of course, that will be great for U.S. trade. It'll be great for the trade wars. It'll be great for demonetizing or de-deficiting our debt, but it will be very, very hard on Main Street middle-class Americans who still think their dollar is what measures their wealth. That dollar is melting, and it will continue to melt as we revalue gold and as we monetize our treasury market with more printed dollars from the short end of the yield curve or from whatever tricks we have at the Fed. It's just debasement. It's just debasement. The average man on the street isn't supposed to know what non-compliance with Basel III means for QE or non-QE QE, what supplementary leverage ratios are, what issuing from the short end of the yield curve is just backdoor QE, or whether, the bailout of the Japanese carry trade was just a form of QE, repurchase agreements, or whether the reverse repo markets is just more QE. Nobody's supposed to understand that complex plumbing, and all I'm saying to you is all of that is dollar debasing policies that benefit Wall Street and DC and not Main Street at all.
Western exchange systems like the COMEX and LBMA are losing price discovery power as physical inventories systematically exit London and New York warehouses. Rather than trading paper claims with multiple owners per bar, Eastern institutions and central banks are demanding unencumbered physical metal. At the same time, clearing and settlement infrastructures in Shanghai and Hong Kong are taking over global price setting, establishing systems anchored entirely in physical delivery rather than speculative short positions. This ongoing drain of physical collateral means Western exchanges can no longer use synthetic leverage to suppress real prices. As bilateral trade settlement shifts toward physical gold collateral outside the petrodollar sphere, the entire post-1971 monetary framework is undergoing a fundamental migration from west to east. Now, let's get back to the interview.
I think to revalue, we can get into that. That's one option, is just to say, like Nixon got on the news in August of 1971 and just said, we're off the gold standard, folks. Wow, that just happened, okay? Technically you could have, someone step out in front of the Rose Garden and say, hey, guess what? The Fed and the Treasury have just used these, slush fund we had since 1933. We're going to revalue gold as a national security measure to 20,000. Boom. Okay. Technically, that could happen. I can talk about how that could happen. I don't think it will, because that would debase the dollar by 80% overnight. I think the better play, and I got to give full credit to Luke Gromen. I've been writing about this for 2 years, but he led the way on making this more clear, of just letting gold run. He calls it the Hamiltonian direction, and how we could revalue gold to get America out of this corner temporarily. Again, step back, just so many may not know this, America does have a hidden piggy bank. We have about 261 million ounces, supposedly, again, of gold, priced at $42.21 an ounce. That's, again, the 1973 price. So that's about 8,131 tons, according to the World Gold Council. Many listeners will say, yeah, Matt, but we haven't had that audited. That's exactly right. I don't know. I'm assuming that's possible. We could have more, we could have a lot less. And even if we did have those 260 million ounces, as many will know, a lot of that may be hypothecated and may be in a vault somewhere, but it's not really ours. So we got to start with the premise, though. Let's just, for simple math, say we have 260 million ounces of gold at $42 an ounce. That is valued at $11 billion. That's a hiccup. That will do nothing to help get us out of debt or cover our yield curve or give us some breathing room or give us a weaker dollar for trade purposes. Even $4,000 gold, if it was marked to market today, would give us just over $1 trillion, which we could direct deposit into the Treasury General Account, which is legal under the Fed's financial accounting manual. We could do that. But even if we marked it to market today, it's certainly better than at $42 an ounce. But at 4,000 ounce, that helps a little, but it certainly would help a lot more if we mark to market gold at 17,000 or 20,000. That gives us trillions, $5-6 trillion that we could use to very much help our yield curve in the long end and help kind of monetize our M0 money supply. So the mechanics of that would be, to me, very simple. It's not about an overnight, we're going to just reset the gold price. What the mechanics involve is not some new policy to push gold higher. It's just get out of gold's way. Because you cannot underestimate how for decades we had zero free price discovery from Chicago to London to New York in that triangle. Zero. There were hundreds of billions of shorts every morning to keep gold and silver artificially repriced, because at that time, for the last 50 years, gold was the anti-hero to the great American dollar. If gold rose too high, that was a middle finger to the greenback, the nothing-backed, all-powerful US dollar. So it was, as Volcker said, the enemy. It's our enemy. Again, today, fast forward many decades later, well, it's not the enemy. And this is what I mean. If you let it run under the Fed's May 2025 manual that came out with the Genius Act 2, the Fed can add gold certificates to its balance sheet, which can then be deposited in the TGA. And if you let gold run, it won't be overnight like some announcement on Nixon. You go 5,000, 6,000, 8,000, 12,000, 14,000. You mark your certificates to market and you slowly, it's like QE without having to print money out of thin air. You're just getting liquidity by revaluing your gold certificates. So it's golden QE is what I'm saying. And again, I think Groman's right. That achieves the Hamiltonian idea of a weaker dollar slowly, and the other Hamilton idea of having tariffs where other people pay for your growth. I don't think that's going to work for a number of reasons. It's a longer conversation. But I do think gold going from America's enemy to now America's last option is pretty ironic. I'm not saying it's certain to happen. I'm fairly confident that it will. We're not going to keep gold at $40.21 forever. There's no logical reason to do that. The other, I think, less likely option, I'll just say it, is to price set it. Under the Genius Act, there is no definition of what is a Fed reserve asset. It's definitely not a monetary metal. But the Fed does have guidance on FX reserves under what's called the Exchange Stabilization Fund. Again, very wonky. It doesn't matter whether people remember. It's basically a slush fund that FDR created from confiscating gold in 1933. And when he did that, he stole your gold legally at $20 an ounce, waited 9 months, revalued it to $35 an ounce, and ipso facto had some serious wealth, and the dollar lost 69% against gold, and that would help pay down debt in the 1930s. We could technically do the same thing under the idea of using this exchange stabilization fund, declaring a national emergency, and then saying we're now going to value gold on our books at this price. Fill in the blank, 17, 20,000. It's very unlikely because, again, that would absolutely crush the dollar immediately as in terms of its purchasing power, too fast.
Official national reserves remain artificially booked at the obsolete 1973 statutory rate of $42.21 per ounce, rendering 8,131 metric tons of gold virtually meaningless on current balance sheets. Yet under federal accounting mechanisms, updating official gold certificates to fair market value offers a viable method to inject trillions into the Treasury General account without raw currency printing. Stepping out of the way to allow unconstrained market pricing creates an asset-backed liquidity cushion that absorbs yield curve duration risks and shores up sovereign solvency. After half a century of treating tangible sound money as a structural adversary to fiat expansion, hard physical assets have emerged as the final solvency backstop for the global financial order. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.